Hey guys, welcome back to my channel. This is Alex, and today's video I will be talking about mortgage points. As a mortgage loan officer myself, I get a lot of questions on whether you should buy points. So in today's video, I'll be sharing with you guys how mortgage points work and whether it makes sense for you to buy down the point. So first things first, points are also referred to as mortgage points, discount points, loan fees, or origination fees. There are many different names for it, but they all mean the same thing. So some people may think that a discount point is like you're getting a discount, but in fact, you're actually paying the lender to buy down your rate. Another thing you need to know is that 1 point is equal to 1% of the loan amount. So let's say, for example, the loan amount is $500,000. 1 point would equal to $5,000. And so to put this in perspective, here's a real life example of what a rate sheet would look like. So on this rate sheet right here, I'm assuming a loan amount of $300,000. And on the left side here, you can see all the rates that are available to you. So one thing to know here is that this is not all the rates that are available to you. There are different rates going down to 5% or up to 7% if you want. Next thing we'll look at are the points column. And so the ones highlighted in red are the discount points you have to pay in order to get that interest rate. And the ones highlighted in green are the ones you will get a rebate for getting those interest rates. And you can think of it like this. The discount points are like a price tag on the rate. So the lower the interest rate, then the higher the cost of the points. And the higher the interest rate, then the lower the cost of the points. And you may even be able to get some lender credits to cover your cost. So as you guys can see that because this is a real life example, there's not a single interest rate on here that has exactly at 0 points. So the par rate in this example would be a 6.5% interest rate, which is closest to 0 points. So the next column is the cost, which is the cost in dollars for the points. So as you guys can see, for 6.5% and up, you guys are gonna get a rebate. And those rebate, you guys can use it however you want. That's your money. You guys can use it to pay for title fees, appraisal fees. And the next column would be the principal and interest payment. That would be your monthly mortgage payment, not including the taxes and insurance. So now we have to find out what is my break-even point. Meaning, how long would it take for me to recoup my cost for buying down the interest rate? So let's take 6.50% as the basis, and let's go down to 6.125%. So if I were to get an interest rate of 6.125%, it would cost me 0.87 points, which would equal to $2,610. So to calculate the break-even point, you will take the cost of points divided by the monthly savings. The difference in cost is going to be $3,060 because you're taking $2,610 plus the credit you'll receive if you were to choose a 6.5%, which is $450. Divided by the monthly savings, the difference between $1,896 and $1,823 is $73, which is your monthly savings. So that number comes out to 42 months. So that means it will take you just 3.5 years to break even. So for this example right here, it may actually make sense for you to buy down the interest rate to 6.125%. But one thing to note is that every lender out there have different rate sheets. And I'm also talking about the increment in points. So for some lenders, it may not make sense to buy down the points. So when you're talking with a lender, make sure you're getting a par rate and a rate below that. And the thing is that there are lenders out there that's going to give you the lowest interest rate upfront and then never tell you about the discount points you have to pay. So you might get super excited like you're getting a low interest rate, and they may not tell you that there's a discount point of 3 points. And that happens a lot during refinances because with a refinance, you can actually roll in the cost of the loan. That points get added to your mortgage balance. So you actually owe more at the end of the day. So something you really want to be careful of, be sure you're asking all the questions. So now going back here, would it make sense for you to buy points? Because usually it will take about 6 to 7 years to break even when you're buying down points. So the $1 million question is, will you be staying at this home for the next 6 to 7 years? And if the answer is no, then you don't want to buy discount points because you will not be living there long enough to recoup the cost. And if the answer is yes, the next thing we'll look at is from an investment standpoint. So for me personally, I invest in the stock market. So for me, I would never buy discount points because I can make way more money investing my money in the stock market. Let's just say that you invest in SP 500, which is the SPY index fund. And SPY has an average annual return of 7 to 8%. So over 30 years, you're going to get much more return of your money from investing in the index fund. Whereas if you invest to buy down the points, you're not going to save that much money. Or let's just say that you can use that $3,000 to remodel your home to make it look nicer so that you can rent it out to better quality tenants. That's going to pay off for itself much more than just buying down the discount point. Or if you simply use that $3,000 to buy better furnitures for your home so that you get more joy out of living there because your home is where your memories are made. So there's a lot of things considered there from an investment standpoint. The third thing you want to consider, which I think is the most important thing, is that we're currently in a high interest rate market. And I think that the Fed will likely lower the interest rate in the next few years. I don't think it will stay at this 6 to 7% level for the mortgage. So right now, I'm not recommending my clients to buy down the interest rate because I think there will be opportunities to refinance in the very near future. Now, compared to last year, when the rates were only 2 to 3%, I recommend most of my clients to buy down the interest rate because they may never have to refinance again. So it will also depend on economic situations. Most people refinance or sell their home in about 5 to 6 years. They might either need to do a cash out from their house, or they are refinancing for a lower interest rate, or they might be just selling and moving out of the home. You never know what's going to happen. So for those reasons, generally, I would not recommend my clients to buy down the rate. Because once you make that investment to buy down your interest rate, then you may never be able to recoup that cost unless you live in there for another 6 to 7 years. And it also depends on everyone's situation too. For people who are on fixed income, they might want to buy down the points because they get that lower monthly payment so that they have more money to spend on other things. For people who are aggressively trying to pay off their mortgage by making extra payments every month, for them, they definitely don't want to pay any points. Because by them making those extra payments, they're essentially lowering their effective interest rate, or meaning that they're going to be able to pay off their mortgage much sooner than 30 years. So I'd rather them to use that $3,000 towards paying down their mortgage every month. So yeah, I know I covered a lot of things here, and I hope this video will give you guys more insight on whether you should buy mortgage points or not. And feel free to contact me. I'm a mortgage loan officer as well. I actually do this for all of my clients so that they're educated on the mortgage process. I help people with purchases and refinances, and I'm working with a broker to make sure I'm finding you the best interest rate out there. Thank you guys so much for watching, and see you in the next video.